Hello everyone, we are live from Chicago. It's Thursday, February 13th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're so glad you're with us tonight. We have new graphics. Before I move on, I want to say thank you to the team, Josh Messick, who did all the new video editing for the 3 new pieces of video we're using, Tommy Else for all his social media marketing, and Heidi Steiner for her wonderful graphics, which you will see as we move forward. Tonight's show, Mr. Wrecking Ball. He's back. 4 years out of office. He's only been in office 3.5 weeks, and wow, has so much happened, and it's affecting us financially, and that's why we do the show. If you are new to the show, please subscribe to us on YouTube. Click the little bell. You'll get notified whenever we go live or when we upload a special. And I have a very cool interview that I'm doing on Tuesday. We'll have to get it edited, but sometime later this month or maybe early March, we'll have an upload. So you want to get notified because it won't be live, but we'll be uploading that. We also tweet every day to Facebook, X, and LinkedIn. And of course, we have our podcast as well. But here are tonight's topics. All right, new graphics. You'll see it's kind of Trump-centric, but that's because pretty much everything in the news now revolves around our new or our returning president. If you haven't checked out our podcast, please do that on Spotify, on Apple, or wherever you get your podcasts. Usually doing 2 a week, sometimes only 1, depends on what's going on in the news. I could probably do them every day based on the number of newsworthy events that are happening, but I need to save my energy. And you'll see them, though, from time to time. I hope you'll subscribe and be there for that. Next month, exactly 4 weeks from today, it's the only time during the year because February is exactly 4 weeks long, 3 out of 4 years. So Thursday, March 13th is the next show. That will be after the first State of the Union address, and I expect to have a lot of commentary on that. That's yet another not missed show. So let's review, since we've got new graphics, new look, new president. Why does CB3 Live exist? Really, 3 reasons. I want to educate you guys, okay? I want to educate you based on what I'm doing for your portfolios. And if you're not a client, that's fine. Educate you on what I'm seeing in the market based on what I'm seeing myself, but also with the people with whom I confer. To edify you. To edify means instruct or improve someone intellectually, spiritually, or even financially. So the verb is often used in the context where there's an intention to encourage personal growth. And that certainly is what this show is about. And even entertain. Let's face it, financial information can be boring from time to time. So I want you guys to feel like it's okay to have a laugh every once in a while. You might even find yourself compelled to do that in this show tonight. So we will see. All right. The monthly market review coming up. What do we got going on here? So U.S. economic growth finished strong. We already did the review for last year, but I just wanted to show you again just how strong GDP was, not so much in the first and the fourth quarter. So look at the 4 red bars there, quarter 1, 2, 3, and 4 of last year. Second and third quarters really strong. And so it brought the overall average up for the year. And that kind of strength puts us high among all the countries on the planet as far as GDP growth. What didn't have a whole lot of great performance was the majority of the Magnificent Seven. As you guys know, those of you that trade our DS or Discretionary Strategies program, DS trades the Magnificent Seven plus select AI stocks that I happen to find compelling at the time. So what really was the killer performer last year? Tesla and Meta. Tesla hasn't so much followed through this year, although it's making some returns. But Amazon doing okay. Apple, Nvidia, averaging 3% or so, declining actually, and Tesla down 6%. But don't get discouraged. You'll see performance, over 7 years in just a little bit here. But the Magnificent Seven has such a huge weight in the S&P 500 that just these 7 stocks can weigh down the S&P 500. Sometimes, and I actually throw in the 8th stock, which is Berkshire Hathaway, Warren Buffett, as the Mag 8 or 7+1 if you want to think about it. But we don't really know how tariffs, which now as you can see are going to apparently be plentiful, how they're going to affect these Mag 7 stocks. We'll be watching that every month. Last month, actually this is through today, or actually through yesterday, I'm sorry. CG having a really good start to the year. It's the blue line. Now, the S&P is not the yellow line. The S&P is the red line. This is highly unusual, but European stocks are outperforming U.S. stocks by a wide margin as the year begins. Not really sure why that is, except that the euro has really softened versus the U.S. dollar. You can see our ratios here, still pretty strong. Biggest profit, 11,500. Biggest loser, 2,800. Remember, we always have more losers than winners, but our ratio, 2.70. Would love to get that to 3.0. We've actually been there at some times, but 2.7 is a good place to be. Down on the lower left-hand side, the winning ratio, 38.85. We're going to call that right at 40%. That's on the high side. That's more winners, and I've just kind of had some success with picking lately in the last 12 to 18 months to bring that ratio right up to 40% or really close to it. The biggest profit, 161%. Biggest loser, 35%. Realize, of course, that doesn't mean the account is dropping 35%. We've talked about this, all right? Here are the biggest winners. Look at the numbers on the left-hand side in green. The biggest losers, all smaller. Actually, the worst losers that we've had since the inception of the new stop-loss management program were all last year, October, July, and July, 2 of them on the same day. But we kept them manageable, well under 1%, okay? So this is GI, growth and income. Now, this is behaving just like it did last year. It's actually beating the S&P 500, and it was all the way to March 23rd when the S&P just caught fire and GI couldn't keep up. This program is not supposed to compete with the S&P 500. I do use it as the benchmark, but you can see just overall, even with only 60% stocks, the maximum drawdown, see the place there on the line on the right-hand side, 1.9% to give this kind of return. That's pretty strong compared to CG, which has more volatility. And then, of course, discretionary strategies, DS, I already told you that was doing wrong. Actually, January 23rd, it was beating the S&P and the European stocks. And then we just got some really ugly earnings from Tesla and Amazon and some of the AI stocks. So it's actually down a little bit on the year, but I wouldn't be too concerned. This is the 6.5, actually 7.5, check that, 7.5 year return on this program, the blue line. I mean, it's killing it. It's killing it, but there's going to be volatility. You can see the downturn of the little blue line, and the other lines at the bottom, even though they're way behind DS, are moving up. So if you can deal with the volatility, it's a great program to be in. Call me. Email me if you want to talk about that and modify your allocation holdings. This chart you've seen a lot of times. Here's what I like about this. You see the 3 secular bear markets, and then, of course, the secular bull markets are the ones that are in between. But the current secular bull market, it started April 10th, 2013, okay, when the S&P broke out of the 2 secular bear markets, 2001, 2002, and 2008, 2009. It broke out of that. Now look at the average return, 12.1%. The entire previous secular bear market was an average of 14.6%. So it's approaching that. And I still think we've got another 6 to 8, maybe 10 years in this secular bull market if the market behaves like it has the last 100 years. All right. So earnings, we always finish this section with earnings. So 308 companies have reported, and the strong sector. So we have 5 leading sectors that are really the growth sectors in America. Financials, discretionary, that's consumer discretionary, technology, and communication services. That's your Googles and your Disneys and other people that are publishers. I mean, Disney is really consumer cyclical too, but you know what I'm referring to. So these are the leading 5 sectors. The only one that's underperforming is industrials, and actually it's performing at the same level as the S&P. 76% have beat expectations. So in general, even with the crazy geopolitical happenings and the incredible volatility caused by this president taking office, the earnings are really speaking for themselves and doing well. U.S. policy, new graphic here. Thank you, Heidi. Politics, none of us likes, right? Although, I don't know, maybe you like what's going on now. Maybe you hate what's going on now. There's probably nobody neutral. But politics, whether you like them or hate them, eventually leads to policy. And policy affects us personally because personal impact translates to our portfolios. And this is what we try to cover in this section. So the title of this was called Wrecking Ball. For those of you that might not be old enough to remember, a wrecking ball is a large steel or metal sphere, typically suspended, I should say, from a crane and used to demolish a building or other structure. Not using them too much now because there's more advanced technology. On occasion, though, they're still employed in scenarios where the alternative methods are impractical. Wrecking ball behavior has also been asserted concerning the 47th president. You're seeing that a lot. Look at the memes on Google or wherever. It's just crazy, all right? So what's affecting this? All right, U.S. consumer sentiment by party affiliation. When Trump took office the first time, you see the red line, all the Republicans felt confident. The Democrats, not so much. And then Biden took office and the blue line jumped up. But you'll notice it didn't really equate to as high as where Trump's approval was. And yet the Republicans' disappointment was lower than the Democrats was. So this is a very emotional electorate we have here in America. And as you can see, we've just got the red line. That's the start of Trump's term. He has not even been in office 4 weeks. It feels like longer if you're like me and you have to follow the news cycle to keep you guys up to date on what's going on. What share of Americans approve of the president's handling of the economy? Well, about 50% roughly during Trump's first term. It started a little bit higher than that and then went straight down for Biden. And then Trump is starting now in this first 3 weeks around 43%. So it's not 50, and we really have no idea where that's going to go. But this plays into the level of consumer confidence. When the U.S. consumers are confident, they spend money. When they spend money, it adds to GDP. When it adds to GDP, it keeps us the biggest producing GDP country on the planet. So it's important to watch these trends. Now, I put this here because you're hearing a lot about tariffs. All right, tariffs, tariffs, tariffs. Why is it that we care so much about Canada and Mexico? And it's because so much of what they export goes to us. A huge percentage of their GDP is wrapped up in their exports to us. And we have an import on our side, import imbalance, and that is what President Trump commented on in his first term. And in this term, he's determined to do something about it. Look at the dependence from 1995, 2010 on the right-hand side, and now, especially on Mexico, they are really significantly dependent on the U.S., and Trump intends to use that to his advantage. Whether these tariffs actually stay in place for any period of time, it's probably unlikely, but he's simply using it as a bargaining tool to get what he wants. Again, it's all about MAGA, Make America Great Again. Donald Trump has been supplanted, word of the day, supplanted by Elon Musk as the most hated and controversial person in America. And I think that's by design, because now Trump is free to sign his several hundred executive orders while Musk is taking all the heat because he's going in. And again, realize when you see the people in the media saying that he's unelected, unauthorized, illegal, he's merely a consultant. He has no ability to fire anyone. He gets his orders from Donald Trump, which is kind of strange because he's about, I don't know, 200 times wealthier than Donald Trump. But this man is working for free, or $1 a month or whatever he's requesting to be paid. But it's tiny. And look at the different areas here. He's trying to trim the government. We all know, whichever side of the aisle you are, we know that the government is simply too big. How we go about trimming it, that of course is going to be the discussion here through the first quarter and into the second quarter. Remember, let me go back here. Remember that Doge is destined to be dissolved on the 250th anniversary of the United States of America, which occurs July 4th, 2026. 250 years old, okay? So his domestic policy actions, you guys know about this. He's determined to overhaul the federal government, would like to trim $1 trillion from the deficit. Realize that's not trimming $1 trillion from the debt. We are adding to the debt every year because we have an imbalance in the budget, which means we have a deficit. So all they're trying to do in this first 4 years is just trim the deficit. It's not going to help the debt unless they really, really significantly make progress. I don't think that's going to happen because we've seen the courts intervene already. We've seen this federal judge temporarily block, but just today unblocked. So you're going to see blocking, unblocking, blocking, unblocking. But truthfully, there are only two numbers when it comes down in the end to where all this is going to play out in the courts. There's two numbers you need to remember. You got to look at it and figure it out. Well, let me get back here to where we are. Here are the two numbers. You ready? You're going to see them over and over and over and over again. 6-3, 6-3, 6-3, 6. All right? 6-3. All right, new tariffs. President Trump rolled out his plan to increase tariffs. You know about this. This is what can affect us financially. Not so much the domestic stuff, although it will, because it affects consumer sentiment. All right? New tariffs are designed to level the playing field. All we're trying to do is get rid of these import deficiencies. We have import inequality with every trade partner but 3 or 4 in their tiny countries. Actually, one of them is Australia. We actually have a deficit with them, and they have more exports to us than we have exports from them. So we think that this is going to help balance, or at least they think it's going to help balance the $1.9 trillion budget deficit. I would like to see, again, $1 full trillion trimmed off of that. All right, here we are at the Fed. And there he is looking over Jay Powell's shoulder. So when I asked Heidi to do this new artwork, she said, Charlie, you know you're going to have to sing this. And I said, I can't do this on the air. She said, well, you know what he's doing there, and you know where I got this from, the Police song, right? And I said, Heidi, I can't do that. She said, you have to. So hang with me, guys. Every breath you take, every move you make, every rate you cut, it can't be too much, so I'll be watching you. There you go. Jay Powell and Donald Trump. We're going to be watching them. Fed holds rates steady. They did that just earlier this week. Last week, I should say. I'm sorry about that. Last week. The consensus, look at the gap here between the black line and the purple line. The consensus is that the rate should be coming down, but the Fed's not budging on that, and that's in the actual news conference that he had. On the right-hand side, the market now has kind of given up. You see the purple line dropping down. They're thinking, we're only going to get 40 basis points. At one point, there was an expectation of 250 to 300 basis points of cuts. Well, I don't think that's going to happen. All right? I just simply don't think that's going to happen, but we keep watching it for you. All right? So I'm going to teach you how to read a dot plot. Anybody heard of a dot plot? Anybody? Say it in the chat if you have. So what we see here are 19 dots, okay? There are 12 governors and then 7 additional votes, all right, that make up the projection for where interest rates are going to go. And each of the Fed governors, there are 12 of them, plus the 7 additional votes that I don't really know where those 7 additional votes come from. but I'll have it for you next week. You can see what it was in December 2023 versus March 2024, and then the projection on the right-hand side, 25, 26, 27. You can see the trajectory is coming down till we get to 26, and then pretty much flat in that range from the high 3s to the mid 2s. The Fed governors are telling you, if you think this is going down to 2% or 1.75%, you can forget it. We can see the trajectory for inflation. And even on the most dovish vote down there at 2.25, I'd be thrilled to have a Fed funds at 2.75 or 2.25, either one. It still means mortgage rates are going to be higher than where they are now. But at any rate, does that make sense? That's how you read a dot plot, guys. So inflation, which is the reason the Fed is in business, that and of course job growth. I know there's a lot on here. And by the way, I got your messages, folks, loud and clear about too much gobbledygook on the screen. I'm doing my best here. If you're watching this on a phone, it's really tough. But I have trimmed down some of the slides. I think there's only one here, but you're just going to have to pause and take a screenshot on if you want to get the date on. That's coming down the road here. But look at the last red bar in each of these. So the change in core CPI. This is inflation heating up. Excuse me. All right. So the change in core CPI is all the components of the consumer price index. And then there's the change in the consumer price index. All right. Just month over month, and see how that spikes up there. All right. The core on the left-hand side is just everything without food and energy. On the right-hand side, it's the total index with food and energy, which makes it more volatile, which is why the bars are bigger. If you take out food and energy, which some people say is ridiculous because you can't live without eating and you certainly can't live without energy, but you can see the bar difference, much different. And then the change in core services without your home prices, because that's the next thing. But any way you look at it, inflation is creeping back. It just is. Now, the expectations from consumers is they see this data and they think, oh gosh, here we go. We're going to be back above 4.3% in inflation. But the 5-year projection, only 3.3%. Why is this so important? Because again, it's just a chicken and egg. The most important engine in this country, and indeed the world, is the American consumer. The American consumer spends when they're confident. They're confident when they don't think that, well, if I spend that money on this couch or something discretionary or a trip or a car, that if inflation comes back, well, I've had that fun, discretionary expense, but now I can't afford eggs. Speaking of eggs, I don't know if anybody can afford eggs. You go into a restaurant now and there's a surcharge. Yeah, you want scrambled eggs? That's $1 an egg extra. It's not on the menu, but we're just charging you that. You go to Trader Joe's and they're just sold out all the time. But that's why the consumer sentiment is so important and why the expectation of U.S. consumers on inflation is so important, and we track it. Interesting, though, that on the earnings call, so when you see an earnings call up there in the corner, they're talking about companies reporting on their earnings. Remember, we talked about this earlier, that we track 4 times a year corporate earnings. The CEOs are not mentioning inflation as a deterrent. So what do the CEOs of America know that the consumer doesn't know? I love this chart because it's been coming down steadily. The number of mentions of inflation on earnings calls has been coming down steadily. And of course, we're in the first quarter of 2025. So if the CEOs are right and they think, you know what, this is behind us, then that's great. That's great. It really is. So I'm going to take a breath and get a sip of water. You guys type some comments in the chat box and I'll get back to you on them if I can. Hey, Steve, good to see you. And Steve Henry, good to see you. Tommy and Lily, great to see you. Thanks for all the social media posting. All right. There's about a 25 second lag here. So if you're typing a question, I'm trying to give you plenty of time to do that, but I'll watch for them. All right. So on the employment scenario, as you know, the employment report comes out the previous Friday before our show, and that's why we do this on the second Thursday. All right. We had good data. No, not really. It should have been good data because the survey was for 175,000 jobs and the actual number was 143. Well, that's less. Why is that good data, Charlie? Because that should tell the Fed that we are in a position where you need to cut rates. Nobody's hiring because they feel like the rates are too high. And the private non-farm payroll in the middle, okay, the survey was 158 and the actual was only 111. So the market really hated this. Yeah, I want to comment. Tommy, thank you for those that eggs. 60 eggs for $20 if you're looking for a deal. I know that Tommy, as a trainer, loves eggs. He's the expert when it comes to finding good deals on the yolks. All right. Thank you for doing that, Tommy. January payroll growth probably depressed somewhat by the weather. We've had a cold winter, not so much here in Chicago, but even in places like Baltimore, but don't have seasonally that much cold, and the Northeast, and just in general, that has put a damper on employment. Here's what areas are looking good so far: healthcare, retail trade, state and local government, and actually even federal government. And I wanted to point this out because that might be the last time you ever see a bar going to the right for payrolls for the federal government, based on what I'm seeing in the first 3.5 weeks of Trump's presidency. So not all areas of the economy perform equally. And of course, we're looking for areas to find that have growth. And so we're looking at charts like this, and that's what affects our stock selection. That's the last segment tonight, is drilling down. I did a little bit on stock selection last month, and a lot of people said, hey, we need more of that. We need more of that. So tonight's last section is for you. Crypto Corner. If you know those last two names, type them in the chat box. I want to see who's paying attention. We know Trump, we know Elon Musk, but who are those last two names? These four were in a press conference in the Oval Office last week announcing some crypto initiatives. So I thought it would be interesting to take a look at where a $1 investment would have taken us in the Nikkei, in gold, in the NASDAQ, in oil. U.S. housing is in purple. It's not even close. But look at Bitcoin. But what else do you notice about Bitcoin? Monstrous volatility. So the reason I'm bringing back the crypto section is that crypto is very much back in the news. There are opportunities here, and I do expect to start trading crypto in DS. I do not expect to trade it in CG, and certainly not in GI. So we're going to be updating trading permissions for all of you clients that are in DS, and we will be trading Bitcoin ETFs, not raw Bitcoin, and we will be employing stop loss strategies. So you're not just going to sit there and hang down through a terrible drawdown like that when Bitcoin was at $63 and traded down to 30-something. So there'll be more on this as we go forward, but that's the reason that we're bringing this back. And you can see here on the global market report, I mean, the number of billions of dollars market size of the currencies is just continuing to go straight up and anticipated to continue there. We have a president who is very pro-crypto, and his favorite assistant, Elon Musk, is also very pro-crypto. You can see from the crypto exchanges what currencies are being traded. Bitcoin and Ethereum have maintained their lead as the number 1 and 2 currencies, well, coins, and then Cardano, Solana, and then others. But it's projected, I mean, it's just astounding growth, and we're not going to miss out on this, okay? It may not be for you, but I'm just giving you a heads up that those of you with DS accounts expect to see various crypto instruments. We are trading Coinbase, which is a crypto exchange. That was just added and already doing quite well. If you've got a DS account, look in there for COIN, all right? That said, here's the disclaimer: bubbles and Bitcoin. Do you remember the gold bubble back in 1980? There was the tulip bubble in the 1600s. The Nikkei bubble, which was they're barely still pulling out of. The Thailand bubble. The tech wreck in 2000. Okay. All right. Another gold wreck. And then look at Bitcoin. And I want to draw your attention to the fact that the chart actually breaks up there. Do you see how it's broken? It's because if they had to show you the relative amount that Bitcoin went up and the amount it crashed, it would be off the chart. So very volatile asset, but we are interested in it because we're interested in capital appreciation and we understand the risks, and DS is an appropriate medium for it. So Economic indicators, and yeah, there he is, Dr. Trump. But reality is, folks, he's affecting pretty much everything in the economy right now. And so these are our new pieces of art. Thank you again, Heidi, for that. Small business sentiment. I like this. I like seeing this rising. On the right-hand side, you can see the long-term average. Most important problem. What is the most important problem? I'm seeing inflation going down. That's what small business is saying. And that is in sync with what you saw a few charts ago, right? Where the small business mentions on earnings, that number was going down. And here they see inflation as a problem is going down. What do they see going up? Poor sales. All right. And they're concerned about the resiliency of the consumer. And I get that. But so far, the U.S. consumer has been strong. Consumer sentiment, this is unusual. It's rotated in an area. Look at the far right-hand side of the chart. That's really all that matters right now is that far right-hand side. This is the University of Michigan's Consumer Confidence Survey. This is issued every month. There's a lot of data that comes out of Michigan, but this is the most famous one. This is a very mercuric datum, all right? It oscillates a lot, and certainly during COVID, you can see the fall there. And in 2009, obviously consumer confidence was really, really bad, and then it rocketed as the market came back. So it's kind of interesting to try to figure, does the market make people confident if the market's doing well, or do people stop spending because the market's not doing well? Which is the chicken and which is the egg? When you know that answer, you could probably work at Goldman Sachs in a multi-mirrored windowed room, all right? But that's one of the datum that we monitor as well. So consumer spending, I mentioned earlier, absolutely remarkable. Look at the last 4 quarters of last year. Well, of the last year, I should say, quarter 1, 2, 3, 4, just straight up. And these economic indicators that I'm showing you here, these are not showing you what's happening now or what's driving the market now. These are data pieces or datums that I follow that could affect us, say, in the second, third, even fourth quarter of this year. These are future trends. This does affect stock selection, but not immediately. What it affects is my bullpen. What stocks am I watching so that when the current stocks look like they're weakening, can I put in there? So that's why I show you these economic indicators, because that's how they play into the investment strategy, which is how we sustain your investments. All right. AI, certainly the most talked about thing on the planet, probably, especially this DeepSeek, this Chinese shock on the market, which happened after last month's show. And here's Mr. Zuckerberg frowning, saying we're creating war rooms to determine just how serious this DeepSeek is. Now, if you haven't heard about this, you probably will have been under a rock or something, but the market's made a huge downturn because it came out that the Chinese have discovered a way to produce a better or equal AI engine for far, far, far less money, meaning they don't need the extensive data farms that people like Kevin O'Leary and other entities are putting hundreds of billions of dollars into to create the electricity necessary, to create the processing power necessary to produce these AI results faster than any other AI engine can do. That's what's going on here. The early signs of what's going on, you can see that spike in ad revenue. AI is helping Meta because of how their search engine pulls results. And I think people go there and they feel like, okay, this is a cutting edge product. We can see our friends and we can keep up with news. So, the operating costs are sort of flattening out. You wonder why Meta's doing so well. Those of you that have, a DS portfolio, and you can see why Meta's been the 20% up this year. That's the gap. You're seeing ad revenue increase and operating costs actually go down. In fact, they just laid off 5% of their staff. I'm very grateful that my son was not in that. He works for Meta in logistics, which is almost a bulletproof position. But Zuck is finding a way to, I shouldn't call him that. Mark Zuckerberg is finding a way to reduce costs while increasing revenues. Every single business in America would love to have that scenario. All right. And if you want to be competitive with the world economy, you need to. So kudos to him for doing it. I think it's great. 2 to 1. All right. So you got $81 billion funded in the US last year in AI. Add every other country up and multiply it times 2, and it's not 81 billion. So all of the really big bucks are being put in place here. Has anybody typed in the chat and told me who those people were? No, you guys don't know. I'm so sorry. Okay, Elon Musk, President Trump, Larry Ellison from Oracle. Anybody else? No? Okay. I'm going to hold off on that, see if you can come up with the last one. But the 4 of them, and it's you need to know who they are. Okay? The 4 of them were standing there, and this gentleman came in from Saudi Arabia and committed to $500 to $600 billion. $500 to $600 billion in investment in U.S. data systems. This was just a few days into Trump's term. Okay? Sam Altman is the guy's name. All right? Young guy, worth almost $100 billion just from his ChatGPT investment. He and Elon Musk founded this. They had a falling out. You can follow it in the trades if you want. But the reality is AI in America, we are kingpin with that. And this president wants to keep it that way. And I want to keep it that way because AI is the emerging technology that will differentiate us from all the other economies on the planet. U.S. housing market. I haven't had a housing section in a segment in a while, but I want to do it tonight because I want to show off Heidi's new art. But also, notice that listings are up 12% year over year, but they're starting to fall off, and that's because homes are taking longer to sell. The zest is out of the market a little bit in the second screen. Homes sold in a median of 55 days. There was a time when the average sales cycle of a home was 17 days. 17 days. Now that was back 4 years ago or so when we were in Nashville and we had this incredible almost 50% bump in the price of our home there, which made it easier to come back to Chicago, frankly, and live in this more expensive place. But the mortgage rate, so 83% of mortgage holders have an interest rate below 6%. I am not in that 83%. Unfortunately, when we came in here, rates were high and it hasn't dropped enough to justify refinancing. But if you have a rate below 6%, you're in pretty good shape. And the rates are dropping for the first time in more than a month. We will see if that's consistent after CPI from Wednesday, from 2 days ago, or just yesterday, actually, I should say, yesterday. What it means is that the housing market is actually overvalued relative to rents. So it's cheaper to rent than it is to buy. This eventually catches up to the market and reduces demand. Why does this matter? Because again, it all goes back to the same story. We're the biggest market on the planet. The consumer discretionary portion of the economy is the biggest part, which your consumer is spending, right? What is the biggest discretionary item? Housing. Second, automobiles. But if housing gets soft and stays soft, it will blunt, I should say, get my words right here, the economy. And we have to pay attention to that as investors. All right, the CB3 investment methodology. Now, in the past, I have shown our performance in this section, but I'm not going to do that. I've already done that earlier. People told me, I just want to, if I can't watch the whole show, I just want to know how we're doing. Okay, I did that. So in this section, going forward this year, I'm going to talk more literally about our investment methodology because I've already shown you about the performance. So people ask, we understand your stops. We understand that you have a risk tolerance for clients, and then you have a very stern risk strategy for each of your programs. Well, DS not so much, but definitely GI and CG. We get it. All right, that's the survey responses, and I'm asking you guys. We send out the survey on Monday. If you've got any questions, you got any feedback, let us know because we change the structure of the program based on the feedback that we get. And the feedback that we're getting is, okay, we get it, but you still have to pick a stock, right? How do you do that? And how do you know when the stock's starting to stink? Well, if it hits the stop. Well, what if it starts to stink before it hits the stop? Does that ever happen? It does. And that's what we're going to talk about tonight. Okay? Stock selection. So Now here we get into the section where the graphics may be kind of tiny, but I'm going to describe what I'm showing. You can hit pause. You can go back and watch this section again. This is our portfolio trading system, more like tracking system, I guess. It doesn't really trade so much, but it tells me, and I can look at, you can see on the left-hand side, what is year to date in CG. So we started out kind of weak, but then we overcame and then we pulled back, and now we're over 7% today. Market's at 4%. So we're beating the S&P by 300 basis points 6 weeks into the year. That could reverse. I am not gloating, all right? Let's look at month to date. You can still see a nice spread there. We've been behind week to date, but we made up a lot of that this last day. So I'm looking for relative performance. The blue line is CG, and it's also GII and DS. I just didn't show you those. It'd take too long. All right, so I'm seeing what happened earlier this week. Do I need to look at 1 or 2 or 3 stocks that are becoming a little stinky? So the next thing I look at is, look on the left-hand side. You can see the percent change today, the total return. I know it's a little fuzzy, but there are 2 components I want to introduce you to. So obviously you could just put your money in the S&P 500, but I don't think you want to do that. So allocation and selection. Let's talk about the difference there. Look on the left-hand side, 3 down, allocation effect. So I actually lost a little bit of ground today because my allocation, the stocks that I picked were not as strong as what was in the S&P, but my sector selection, see the sector effect? That was really strong today. All right, 0.28 basis points is a lot. So the total effect, you have to take 29 minus 19 equals, roughly 27 because of the weighting. Then I look at the various stocks. I see that, Robinhood, which is a discretionary trading stock company. It's a company like IB, but it's really more for smaller investors. That really did well. United Airlines not doing so well. I can see the overall graph of the pie chart on the left, on the right-hand side, but of the 2, I'm on the left with CG, and then the S&P was just up in everything. Well, we weren't up in everything, but we still beat the S&P today because we had some winners, like in the middle section, Robinhood, and even Concept Therapeutics, okay, which was up 4.9%. So we have some really good winners, and that's what we're looking for. But I don't care about the winners. I mean, I do, but what I really care about are the losers. So I'm going to look at the holdings, and I zoomed in on this. This was the chart that was too small last time, but I hope you can see this. Look at the column headings: allocation effect, selection effect, year to date, last 3 months, 1 day, and I'm looking at all these stocks and seeing if I'm seeing a trend year to date, last 3 months, 1 day. I do look at 1 week too as well. I just didn't put that on the screen. There's so much data, guys. Sorry. And if I see a trend going in the wrong direction, meaning red instead of green, then I am going to look at that individual stock. We're going to pick on ETRN, which is actually doing well. But I want to look at this. I've got all these categories, the financials, estimates, price and charts, a description here. And then I can go and look at the debt and credit. I can look at its peers and the valuation of its peers. And then you see the little white caret there. There's just tons of data on this, but I really spend some time thinking about this. Are you causing me a problem? Because I need to tell you something. I'm talking to the stock now. I date my stocks. I married my wife, but I date my stocks. If you are pooping on CG, you are dead to me, ETR. So I can go in, and the first thing I'm going to check on the second screen is, okay, are you still outperforming? So the purple line is ETR. The S&P 500 is the white line, and we're going back 1 full year because year to date's not that much. It's 6 weeks. And you'll never see a stock, and I can use the word never, stay in one of my portfolios if it's lagging the S&P 500. It needs to be ahead of the S&P 500 significantly, and my goal is to catch this as soon as possible so I can enjoy this move. It's really tough to do, but we're doing okay with this one, all right? So year to date, pretty strong. So I don't think this is a problem. Next, I go to what is the mean? So that means what's the middle performance range of all the energy stocks and then all the electric utilities? Well, it's above, you can see the little purple line is to the right of the electric utilities. So as a relative performer in its own sector, it's doing well. All right. Over to the right, I can see, just looking at how other analysts, do I look at other analysts? I do. I don't know everything. I want to see what they're rating it. Well, they're rating strong buy 4, a buy of 8. 8 are recommending hold, and nobody's selling this thing. All right. That's strong. And I can see below that, the 3 stars and the 5 stars. I'm seeing an overweight recommendation, an outperform. These are strong. And then I'm just going to look at one more category because I know, guys, your eyes are glossing over here. Well, actually, no, I need to show you a little bit more. Hang with me. We're almost done. Global rank. All right. How is this doing in its PE ratio? Okay. Price to earnings ratio. It's in the 38%. Not great, but okay. Dividend yield, 63%. Now, normally, dividend is not a big deal for CG, but if I can get growth and dividend yield, then that stock insulates it better. This stock, if it ever gets stopped out of CG, or when it gets stopped out, it will definitely. It'll probably go back into GI because it has such a strong dividend. You can see right here, the dividend yield is in the 63 percentile. Do you see that? Now, this EV sales is a 21, which means it's near the low, but it's the only really bad number on here. And the price to cash flow at 68%. I mean, there's a lot of data on here that's important. And then I can look at the trailing 12 months and the next 12 months, all these different parameters. I know that this is kind of geeky, guys, but this is what it takes to produce a portfolio. I mean, that's what it does. So we're selecting a stock, we're monitoring the stock, we're looking at it in multiple time frames. It's checked every day. Most of the time, almost all the time, we do nothing because it's doing well or it's going to hit its stop and it's gone. But if something's just stinking and it's just sitting in there like a dead weight, but it's not so bad that it's getting stopped out, it's using capital that needs to be used for a better opportunity. So that's part of my job. That's what I do. And I have the tools that you've seen here on the screen to help me. Now, I just showed you one stock. There are 33 stocks in CG. There are 21 stocks in GI. There are 13 stocks in DS. I don't look at each of them every day because I can look quickly on the chart and say, good, 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 good. No, you're not so good. And so I'm looking at the troublemakers, which is usually 6 to 8 of that whole crew. Again, because I've been doing this. I mean, Moses and I pick stocks together, guys. Let's just be real. So at any rate, I hope that helps. I've had people ask me. And then the last thing is that people say, well, why don't you just pick a area of the economy and just hold it? You know, like consumer discretionary in 2015. Look how well that did. Next year, just invest everything in consumer discretionary. Except that next year, consumer discretionary stinks. All right? And then you come to me and say, well, energy, it's on fire. 27%. We got to do that next year. So in 2017, if I did that, where do you see energy? -1. All right? I won't go through every square on here, but if you want to take a picture or come back to this, this is why we manage money. You can just put it in here and hope that your sector, or we pick a stock or two in every sector, but that's not going to outperform the S&P. There are going to be some years when we really outperform, but there are going to be some years we lag. Bill Miller beat it for 15 years and hasn't beaten it for more than 2 out of 7 years since then. All right, but we hope that we dialogue with you, we communicate with you, we mostly beat the S&P 500, and we educate you and edify you, and I hope entertain you to make you feel confident that we have your best interest at heart and we're working really hard to give you the highest risk-adjusted returns possible in your portfolios. Make sense? All right, that's the show. That is the show. There are segments next month, March 13th. Word of the day. Today's word of the day is actually under consideration for being added to Webster. Terrified. And this comic says, did you say terrified or terrified? So Mexico is probably upset with us. Are they terrified of us? Or are they terrified of us? That's the phenomena when individuals or businesses have fears about how import-export imbalances could affect their financial future. If you are terrified, let me know in the Monday survey email that you get, and we'll address more of that in March, okay? I promise. Please follow us on Twitter, as we say all the time, but for our podcast, follow us on Spotify, follow us on iTunes, or wherever you get your podcast. We're reaching out to you every week with fresh content. We've got interviews. We got all kinds of fun stuff. Tommy Ellis is there making it special for you, keeping it up to date, and hope you guys will tune into that. Don't miss next month's show. Again, it will be after the State of the Union address, so there'll be a ton of things to talk about, I am sure. As we always close with, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. 2 Timothy 1:7. There are some of us that think this is the next golden age of America. I probably think a little differently than I did 3.5 weeks ago. This is definitely the roller coaster era of America. There are a lot of good things happening. I'm not so sure about everything. I just have to wait, and I'm fortunate that it's out of my hands. My ability to predict is not nearly as skilled, nor is it as important as my ability to react. You're paying me not to predict, folks. Remember that. You're paying me to quickly and promptly and decisively react to an unpredictable market, unpredictable geopolitical situation, and definitely the most unpredictable CEO in the White House, probably since not Reagan, not Franklin Roosevelt, but since Theodore Roosevelt and busting up the big mega corporations back in the early 1900s. We're going to do our best to maximize your returns with a risk-adjusted mindset. We're going to keep doing it. We appreciate you being here. Thank you guys for watching. God bless you. We will see you next month.